Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this session, I want to bridge from some previous videos we did, but had insufficient time to dwell further into one of the major equity market issues in today's markets. Specifically, we want to attempt to shed some light on why market breadth is historically narrow to an unprecedented degree. I am referring, of course, to the domination the Magnificent Seven stocks now command. As I pointed out in the recent weekly newsletter, the 5 largest companies as a share of the S&P 500 total market capitalization is now 27%. The 10 largest companies as a share of the S&P 500 totals 37%. As such, I want to cover the subjects listed here as a springboard from the April Under the Lens video entitled The Future is Coming into Focus to support some of the conclusions we drew in that video. I want to start by some positioning regarding the divergence we see between rising prices and falling stock volumes. Our longtime subscribers are quite familiar with this chart, which you can see by the copyright at the bottom. We drew in 2012 as we came out of the financial crisis by removing mark-to-market accounting regulations for derivatives and hurriedly implementing the untested monetary policy of quantitative easing. We felt at the time the path forward the Federal Reserve was putting us on could only lead to malinvestment, dysfunctional markets, and delusional valuations. We didn't know how long it would take, but the outcome was fairly assured. We believe the markets have now arrived at that endpoint. We presently have ineffective price discovery as a result of the mispricing of risk. The U.S. dollar, as a consequence, is seriously overvalued, effectively crippling the rest of the world and driving the creation of the growth of the BRICS 7 as a threat to the U.S. dollar as a global reserve currency and the 10-year U.S. Treasury note as the international risk-free benchmark. As a result, we are in the midst of an unprecedented debt-for-equity swap. It is the epitome of the indirect exchange, which we have also outlined in 2 videos, which can be found at the Matasi website or at the Gordon T. Long YouTube channel. To understand better what is occurring, we need to look at the long-term chart of both price and volume of the S&P 500. As the S&P 500 is carried almost parabolic by the explosive rise of the top 10 stocks, we see that volume at the bottom has steadily fallen. This all started with the 2008 financial crisis changes. Prior to that, as price rose, supporting volumes also rose. Most will quickly and somewhat accurately point out that this correlates with the advent and growth of ETFs and the use of options. That is true if we fully appreciate that ETFs don't actually buy the underlying stock, but rather use options to mirror price change. Therefore, the chart represents not equity activity, but frankly options activity. Who is mirroring who? But I digress here. No one truly knows how big the option market is because quite literally hundreds of trillions of dollars of currency and interest swaps are traded over the counter with limited to no regulation. With well over $1 quadrillion in notional value, what we need to appreciate is that the derivatives are traded on literally every element of the markets, including, as examples, economic indicators such as inflation through inflation swaps or collateral through collateral swaps and collateral transformations as part of credit metrics, and the list goes on. This week, as we waited for the CPI to be announced, the markets were moving as inflation swaps and other derivatives traded in advance, which had a direct bearing on the stocks in the way of supporting valuation and equity risk premiums. This is what I was referring to as who is mirroring who. This chart from Richard Duncan, a global financial expert with experience at the World Bank, the IMF, and the Thailand crisis, he believes any market in the world could be manipulated with only a few $100 billion worth of over-the-counter derivatives contracts. Today, we see the parabolic lift in options by ever-shortening expiration, and this chart is before the new daily option ODTEs. The markets have clearly become a casino. Like any casino, the only real winner is the owners of the casino. For anyone having owned a business or been part of a larger corporation, you know, even the casino owners answer to who is financing the business and who has the collateral claims as a senior secured debt holders. They are the ultimate owners and where the real boardroom power rests. which takes us to growth in buybacks, or what is debt for equity swap or exchange. There are many reasons that corporations buy back their shares, from creating attractive PE ratios to debt financing tax advantages. We need to remember that many corporations are now borrowing to buy back shares and even pay dividends. Again, we see the parabolic lift. But who are the financiers of all this, and how do they win? There's an old investigative adage that says, always follow the money. In this case, it's follow the parabolic lift of the money. Not all markets, indices, and stocks are rising actually in a parabolic fashion, just a few. What we noted ourselves a long time ago was that it started with a parabolic lift in debt and derivatives. And though it ended with the Mag 7 and NVIDIA, we found private equity player stocks who also entered into the fray as sovereign debt went parabolic. Private equity is now the dominant player within what has become known since the mid-1990s as the shadow banking sector. These are lenders who don't operate as regulated banks, but are creators of credit. As creditism has replaced capitalism, the creation of credit, which is the opposite side of the debt coin, has become of central importance in today's debt-encumbered world. We had, for example, $62 trillion in government debt on a global economy as measured by GDP in 2020, $85 trillion in debt. It was $82 trillion in 2022, 2 years later, with a GDP of $104 trillion. This is $20 trillion of new debt to grow the economy by the same $20 trillion. It takes debt to grow, and without economic growth, profit growth normally does not occur. We've got a dollar-to-dollar ratio going here. It is interesting that the profits of the top 10 stocks are growing significantly, with inflation in nominal terms. With inflation a direct result of increased deficit spending, or too many dollars chasing the same amount of goods. Banks are not doing exceptionally well, as U.S. bank reserves haven't been driving exchange market capitalization since the Fed started raising rates. Well, we know with a fair degree of certainty, with breadth so narrow, those involved in any way with the top 10 are likely to be doing fairly well. The rest are barely beating inflation in nominal terms. So who has the yachts besides the founders of those top 10 big tech firms? Well, it doesn't take Sherlock Holmes to see that it is with the labor and stock-based compensation costs of the largest listed North American private capital player. They have totaled over $100 billion over the last 5 years. We'll come back to these shadow banks, private equity, in a moment. Let's revisit something we uncovered a number of years ago, as these parabolic curves were just beginning to form. In the April 2018 release of the LONGWave video, which was entitled Understanding the Disappearance of Stock Floats. And then again in September of the same year, we followed it up with more detail in another LONGWave video entitled The Disappointing Equity and Float Pools. Both videos are available, again, at the Gordon T. Long YouTube channel. First, we need some definitions here. The float is the number of shares actually available for trading. Float is calculated by subtracting closely held shares owned by insiders, employees, the company's employee stock option, stock ownership plan, or other major long-term shareholders. And we'll show you a list here in a second, from the total shares outstanding. So as they build theirs, this pool comes down. This can be difficult actually to determine. It depends on definitions and actually getting anything close to real-time information. It's always significantly delayed. What we showed in the videos was this S&P's 500's dirty little secret, how extremely quiet changes in the methodology fundamentally transformed the index. 3 examples of how the S&P 500 index methodology had been quietly but substantially changed since the dot-com bubble burst. In 2002, it was the removal of all foreign companies from the index. Then in 2005, and this is really key, the shift to a float-adjusted market capitalization. Float-adjusted. And in 2014, the inclusion of mortgage REITs. Since 2005, the S&P has been float-weighted. It is a float-adjusted market capitalization index. When the individual market cap is calculated for a company, part of the index, only the outstanding shares that can be freely traded without any restrictions, are taken into account. Not all outstanding shares of a company are available to common investors to trade. For example, shares held by individuals with access to insider information are under special regulations. The float-adjusted value of the S&P 500 index in 2016 approximately was around $1 trillion, smaller than the unadjusted total cap. Shareholders concerned with control of a company and have regulatory restrictions generally include the list shown here, a long and interesting list, a list that is dynamic and not highly visible in, as I said, in real time, but only after the fact. And as I point out here, number 2, private equity, venture capital, and special equity firms are included with this whole other list. The following holders' shares are generally considered also part of the float. We're taking out a substantial amount of float with a substantial amount of players who are all going into these stocks, who are then in turn buying a smaller and smaller pool. They themselves are creating the market for the stocks going parabolic. Where's their financing coming from? But many of them are finance companies. They are, in fact, shadow banks. In these videos, we show a litany of charts of how restricted control and release can be used to impact stock prices and trading back then, and it's only got worse, frankly. Papers from the Harvard Business School in May of 2005 entitled Float Manipulation of Stock Prices were strongly warning of what was possibly going to happen, and that's before some of these changes were made. When a firm reduces the number of shares available to trade, then the so-called float manipulation occurs. The price of the stock is often driven up. Stock prices are raised significantly when there are differing opinions about the stock values, about the value of shares, when risk-adverse investors have differences of opinions and short sale constraint, reduction in float frees out pessimistic investors, pushing up prices. There's another game that can be played here. And when the float is released, prices fall. When you finally get that data, we felt strongly back then that this fit into a roadmap of controlled distortion that was underway or was going to accelerate. I think the proof today is pretty obvious without a full forensic accounting of the whole process of matching both stock equity and stock debt funding. I said we would get back to private equity as a major player in this area of what is now called shadow banking. Globally, it has become massive in scope. Just 9 U.S. private equity firms alone have nearly $1.2 trillion in unleveraged assets. The leverage ratio, however, shows you just how powerful the lending and finance cloud is. Banks operate with debt-to-capital ratios of 9-to-1. Shadow banks operate with 2-to-1. If the shadow banks buy U.S. treasuries and put them on deposit with money-centered banks, they could secure leverage loans at extremely high leverage for trading positions. And that's why leveraged loans, for example, are becoming a dominant instrument in the credit markets. The leveraged lending could come from anywhere around the world with a multitude of partners operating under different jurisdictions, tax situations, and currency and interest swap positions. Shadow banking is now as big, if not bigger, than the traditional banks as lenders operating without banking regulators on a global basis. This is truly the Wild West of global lending, finance, and market manipulation through the also uncontrolled derivatives complex. So what can we conclude? We must not forget that the Magnificent Seven are benefiting from rising earnings projections. These earnings, in turn, are benefiting significantly from something we haven't talked about, and that is net interest expense. To unpack the full reason for negative net interest expense would take another video. I have tried to encapsulate a number of the points we have touched upon in this video in a single instructive slide as shown here. The parabolic curve benefits more than the corporations whose stock are involved and the investors benefiting from it, but also the shadow banks and specifically private equities that might be involved. The shadow banks potentially benefit really in 4 ways. First, by lending to these corporations, they become creditors and in many cases secured lenders within the capital structure. We have little visibility to what covenants come with the lending, but fully understand the structuring of these covenants are the central expertise and raison d'etre of private equity. It could be extremely complex and very secretive. Secondly, the money being lent by the shadow banks has itself been secured in various fashions to be paid back also in various manners. This includes international rates, currencies, and derivative swaps. Thirdly, the private equity firms can trade the stock while at the same time playing the float game. that we've talked about earlier of restricted stock timing eligibility. Fourth, this is a critically important element of the concept of the indirect exchange we've been talking about in our newsletters and 2 prior videos on this subject. Lenders are the losers in an inflation environment, while the winners are the borrowers, who pay the back money at a later date and less value through purchase price erosions. The shadow banks are really operating as borrowers by being protected pass-through lenders. All this works because of a lack of effective price discovery, mispricing of risk, and an overvalued U.S. currency and the global financial game of debt for equity. It is an opportunity to prey on the illusion of growth, misunderstanding of money and wealth. Hopefully, this video adds to the 4th and 5th points we made in our April Under the Lens video entitled The Future is Coming into Focus. The coming debt crisis will be triggered in our opinion, from an implosion of this derivative securities complex. And the Great Reset will be about collateral confiscation through the Great Taking, which we talked about in this year's thesis paper. Again, we encourage you to read the well-researched book, The Great Taking. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as actually no one will take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and overall global policy paralysis coordination. I would like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there's actually seldom been a better time for investing. However, it requires careful analysis and not following what has become traditionally the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2024 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.